Hey, welcome to the podcast, everybody. Thanks for joining me. Appreciate it. I'm doing it a little early today. I do have some meetings to attend, so I won't be able to do it after the market close like I typically do. So right now, with about 20 minutes to go to the close, the Dow Jones down about 54 points after being up earlier on the day. I'll show you the S&P here on a 5-minute chart just to show you what we have done today. And, of course, we had a rally at the open. Sold off a little bit, rallied back to a high of the day, and then it's been down pretty much ever since, and you're getting some what could be potentially some short covering at the end of the day. But here we are. We were down 80 just a few minutes ago, down 40. Very volatile. Volatility's picking up. I wanted to get this podcast out tonight, even though it's going to be a little shorter than normal, simply because we're getting to that point where your finger's on the trigger. And you have some positions that hopefully you're not overly invested in this market to begin with, whether it's emerging markets and materials and financials. I'm very light in those areas. In fact, I don't know if I have anything in the material space or the financial space other than a credit card. So I've been light in that area and still have lower volatility, low beta type of investments and a lot of cash. Obviously, there's some stocks that I'm hanging on to that are getting quite oversold, so I'm in a position to hang on to some of those, and I have a small short position on the Russell 2000 in my more aggressive trading strategy. So overall, it's still in pretty good shape, but if you look at the market right now and you're heavily invested in it, you are at that point of saying, I gotta bail here. Right now, the stock market is really penalizing you for hanging on to just about anything. Now, what's a little different today than what we've seen in the past few days is, remember, we've been seeing a lot of leadership sell off. The Apples, the Pricelines, the Chipotle Mexican Grill, the Starbucks, all those stocks that were doing real well were selling off. Even some of the retailers, TJ Maxx, those types of companies, they have actually, there's a lot of stocks on the screen, even with the market down, that are still green today. So you're not getting that overall capitulation, panicky type of bottom that I would actually like to see. However, I think at this point, the market is at a stage right now where we should see a short-term rally. And it's simply because I think we're at an exhaustion point. I don't think it's a low that is an investable low where we really have an October or November setting up where it was just sheer panic and there created some really good opportunities. I think there's some stocks that are opportunities, but the overall market character obviously has changed when you look at what we're looking at here with moving averages crossing, obviously the 20 crossing the 50. We have the 100-day moving average breached now, which is the red line. And I've put the Fibonacci retracements on here, which are, obviously technical levels that a lot of traders watch. And I kind of marked it from the November low up to the recent high. And you can see a 38.2 would be somewhere around, probably this 12, I guess it's a 1321 area. That would be the place where we would see the Fibonacci retracement. Now, if you take this retracement all the way back to, let's call it even the closing level here, or the intraday low, the open from that day of October, then you're looking at something that could get you down to, even 1290 or so on the S&P. And look, the fact that we're at 1331 or so, obviously we could easily go down 30 more, 40 more points in the S&P, which would be another 3%. At that level, then you're probably talking about some things that are some screaming buys. And we're seeing some things that are becoming screaming buys. But it's hard when the things that are beaten up, i.e. materials, are justified for being beaten up because the economy is slowing. China is easing because their economy is slowing. Greece is obviously thinking about exiting the euro, and it's maybe only a matter of time. You still have Italian banks getting downgraded. So it's justified that this stuff is falling, right? So how can you go in and bottom fish on some of the things that should be going down? Well, even though they should be going down, there are times when you still want to buy them because they're simply oversold a lot. And I think we're getting to that point on some of these stocks. But in general on the market right now, when we kind of zoom in here, I think what you're seeing is you're at a point now where the market is down. It's going to be down 9 out of the last 10 days, or 10 out of the last 11, or some number. I don't feel like counting the little bars there. But the bottom line is we've been going in one direction for a long time, and we're at the point now where people are they may not be panicky, but they're certainly hitting their stops and hitting the sell button because they've reached their panic threshold or their uncomfortable threshold. Maybe panic's not a good word, because I don't think we're seeing panic. In fact, I think that's why the stock market has been falling almost at the same rate as it was going up. It's a very methodical increase back here in the January, February. It's kind of a methodical sell-off right now. We're not seeing these 250-point down days. We're seeing 125 on the outside, or maybe 60 or 70. So we're not getting that panic that I think leads to a real, let's call it a multi-month bottom. But we are getting to the point where we should rally based on some very short-term exhaustion indicators. And when I say that, exhaustion indicators just means things are going in a direction and they're going to be done going in that direction, whether it was up or down. And I think we're getting there today. I actually would prefer, we have about 15 minutes left, I would prefer a down close on the day, not necessarily at 150 points, but a down day would complete that exhaustion. I think we could see a rally. Now, the next logical question is, where does that rally lead us to? And obviously, the spot which we kind of broke through, which you could go back and draw a line somewhere right in here, and if we kind of extend that out, maybe we do get that rally that takes us back up a little bit, and perhaps takes us, and we work our way back up to here, and then we start to fail again. And if we do that, that would be the place, if we go up to that line and we have very low volume, and we don't have the leadership come back, and we don't have overwhelming demand, it's simply the sellers taking a break. Remember, when I talk about the sellers taking a break, what we saw back over here were buyers taking a break. Those were times where the buyers simply took a break, and we still saw no antsy sellers. Now what we're seeing is we're seeing the selling pick up, but we're also seeing the obviously the demand for stocks dry up. And if we have a bounce, and it's simply because the sellers are saying, you know what, prices are low enough now, we're going to cover our shorts, and we get this bounce, and it's mediocre, then you can go and you can actually short more. And that could be that you go in there and sell more positions that you have, or that can mean that you simply go in there and short more. Either way, taking your overall volatility, taking your beta to a lower number is the key. But I don't think you want to do it at these levels right here unless you're forced to do so. And when are you forced to do so? When you can't sleep at night because, let's say the market goes down 1.5% and you're going down 1.5% or 2%. If you're going down 1/3% or 0.5% while the market's going down 1%, 1.5%, then, you're moving half, a quarter, whatever it is that the market is. And so you're in a much better position to make reasonable judgment and good decisions on what should be sold and what's getting sold off just because people have to hit the sell button. There are stocks out there that should not be going down that are. I mentioned at the beginning of the podcast there are stocks that are going down that are justified to go down because they're a very cyclical type company. But there are companies right now that are going down simply because there's profit taking and they're held in mutual funds and they're getting sold. So those are the ones that you want to cherry pick. But overall, I think right now the ones that shouldn't be getting sold, those will provide an opportunity. But we're going to see a lot of volatility here, obviously, and we're seeing it right now just in the last few minutes of today, May 15th trading day. The market was down 80, then it was down 40 just a few minutes ago, and now it's down 70. Just in the last 10 minutes as I've been talking, we've seen this type of volatility. But the bottom line is we are getting to an exhaustion point, and I think ultimately it's going to lead to a bounce. But it's not a bounce that I'm telling you is a bounce that is going to lead to, this thing just taking off and up we go. I don't think it's going to lead to that. In fact, I think what we may see, and it may be a little too obvious, I don't know. I mean, obviously a lot of people are in a bearish mode right now, but I do think a rally to some level up here will cause more sellers to come in. and look for that trend. And again, what would happen is we would regain the 100-day moving average, and I think the bulls at that point would say, "Aha, just a garden variety correction, we're good to go." But what I'm seeing is not a real panicky situation. I'm seeing a continuation of a deterioration that's been going on for a few weeks here, and let's call it a couple of months, where you saw the leadership. You see the demand going away, and now, in combination of the demand going away, you're seeing the selling pressure pick up. There are still places to hide, which is good as far as there's some staples that have been doing okay. There are places like some REITs that have been doing well. We're seeing a lot of closed-end bond funds. There's those types of things that last summer they were going down just as fast, if not faster, than the overall market. We're not seeing that this go-around. Is it yet to come? Possibly. Because what happens in a bull market that's becoming a bear market is that you see sector by sector peel off, right? The commodity stocks have already been getting hammered. They've been getting hammered for some time now. And then now you're moving on to, you're working up to the financials. Then you're working up to the cyclical stocks. And now what you're seeing is the leadership go away. Then the next thing is, okay, the defensive stocks, large cap, staple, recession-proof stocks, do they start to fade? Do bond funds, which are bonds but trade like stocks sometimes, do they start to fade? If that happens, then obviously you get into more of a serious situation. Right now, we still see deterioration, and the only thing that can save the day is an overwhelming change in demand, where the demand really picks up because things are really cheaper. But let's look at this. By the time I post this, I will have either posted or will post afterwards an article on J.P. Morgan. We have Europe, which is reminiscent of 2010 and the summer of 2011, right? It's coming every summer now, like clockwork. The black swan is becoming the white swan. But now we also toss in J.P. Morgan, which has this $2 billion loss. And it's funny because I was watching one of the morning shows this morning, a non-financial network, and they were talking about the scandal at J.P. Morgan. It's not a scandal. That's not what's happening here. It's a dumb decision, and it's extra risk-taking that shareholders are saying, we didn't want that type of the trades and those types of risks. So it starts to bring back memories of 2008 and the financial crisis and going too big to fail. And all those things that scared us then and were real, you combine that with Greece and Europe and Italian downgrades, and you add to that our economy slowing down, and you add to that less demand for stocks and more supply, yeah, the Dow's going to have a negative sign in front of it. So again, is it going to get to a price where demand really comes up and people scoop it up, and we see that, and it's very evident in a very high volume, intense 90% upside day? Or do we get a lethargic bounce? If we get the lethargic bounce, I will be reducing more exposure to the stock market, which is already low, and I will increase short positions as well and take a much more defensive posture than I'm already at right now. Okay, that's my quick podcast for today. As it stands right now, we've got about 5 minutes to the close. Dow Jones down 67 points, the NASDAQ down 8, the S&P down 8. Russell 2000 is actually in NASDAQ holding up better than the Dow and S&P, which is interesting. And once again, Treasuries doing well. Interest rates down to 1.7% on a 10-year Treasury. Quite amazing. Hey, don't forget KarlEggers.com and Twitter.com/Karl Eggers. We also have EggersCapital.com for money management side of the business, and we have Google plus Karl Eggerss. Thank you for joining me. Appreciate it, and we will talk to you soon.